Why do interest rates change based on global events? Have you ever wondered why interest rates fluctuate in response to events happening around the world? It's a fascinating topic that connects global happenings to our everyday finances. Let's break it down. Interest rates are essentially the cost of borrowing money. When global events occur, they can influence economic conditions, investor confidence, and the policies of central banks. For instance, political changes, economic crises, or even health pandemics can create uncertainty in financial markets. When uncertainty rises, investors often look for safer investments. This can lead to increased demand for government bonds, which drives bond prices up and yields, or interest rates, down. On the flip side, if confidence in the economy improves, investors may shift their money into riskier assets. This can push interest rates higher. Central banks, which are responsible for managing a country's currency and money supply, respond to these changes by adjusting their benchmark interest rates. For example, during a global economic slowdown, central banks may lower interest rates to encourage borrowing and spending. This helps stimulate economic growth. Conversely, when the economy is strong, they might raise rates to prevent inflation from rising too quickly. For students building credit, understanding these shifts is important. When interest rates rise due to global events, borrowing becomes more expensive. This can affect your ability to manage credit affordably. On the other hand, when rates fall, it might be a good time to borrow or refinance existing debt. Let's look at some specific global events that can influence interest rates. Political events like elections or trade disputes can create market volatility. This volatility often leads central banks to adjust rates to stabilize the economy. Geopolitical tensions or conflicts can disrupt trade and supply chains, which can also impact inflation and prompt rate changes. Global crises, such as pandemics, usually lead central banks to lower rates to support economic activity. Additionally, changes in interest rates from major economies, like the United States, can have a ripple effect internationally. This interconnectedness means that rates in one country can influence rates in others. For students, keeping an eye on global news can help you anticipate changes in borrowing costs. Building credit responsibly during periods of low interest rates can save you money in the long run. Understanding that rates fluctuate with global events can motivate you to maintain a good credit score. A better credit score often leads to lower interest rates on loans and credit cards. In summary, interest rates change based on global events because these events shape economic conditions and investor behavior. By staying informed, you can make smarter financial decisions as you build your credit.